What if you could invest in real estate, not having to pick up a hammer, even enter a house, or ever even leave your own house? Well, you can. Hi, I'm Rebecca, and thanks for joining me on the Mama Lorian Way, where I'm documenting my journey from stay-at-home mom to millionaire. So yesterday I talked about, and you can check it out, I talked about passive income through rental properties, like houses that you have tenants. And today I'm going to talk about private lending. Okay, what is private lending? Sometimes people say hard money instead of private lending. And what it is an alternate, another source of loans for real estate investors who need to move quicker on a buy or rehab than traditional sources like banks can fund. It's lending by private individuals and companies, or maybe even a combo of the two. It's usually short-term, interest-only, and at higher interest rates than banks. All right, who could be a private money lender? Anyone can, and I'm going to say, as an aside, not everyone should. There are risks, and we'll talk about that. It's good for individuals with a surplus of cash sitting in a savings account making less than 1%, I think it is now. For people with money in a self-directed IRA, I will talk about that in a future video. And then those wanting to get involved in real estate but prefer passive income to active involvement. We call them armchair investors. Now let's talk about some of the good stuff in private lending. Get a return on your money without doing the hard work, and it is hard work, of finding the properties, buying, negotiating, rehabbing, and then selling it. You get higher return on your money than in savings and CDs, and typically it's between 6 and 15%. Depending on the risk involved. No upfront costs, save probably your bank wire fee. And it's great for your self-directed IRA as it's always at arm's length. So those have to be transactions that you can't physically even go into the property. Best of all, mailbox money. It's money that just arrives every month, every quarter. Put it into your account. Basically all you have to do. Is this too good to be true? Well, there are some cons, right? There is a risk. Maybe I should say it's a risk. Biggest risk is borrower default, meaning they won't pay the loan back. There's overages that they may not have anticipated. Things come up in construction. There's shifts in the market. There's recessions, because this is a long term. Things can happen within a year. Maybe just sheer inexperience and got in over their heads. This default of the loan is cured by foreclosure, which is a legal process that involves a lot of time and a lot of money, and it results in the takeover of the property to recoup the investment. It's in your best interest, if you're looking into private lending, to have a good knowledge base. Like any investor should have a knowledge base of what they're investing in, so that you can vet the borrower and the property and maybe the broker as well. We call it due diligence. What? Due diligence? Okay, it's not so scary. I got a lot of animals today. It's just the process used to assess and minimize risk. So in private lending, one of the first things to look at is the lien position. And there can be multiple loans or liens on a property. If you're in first position lien, means you're the first one to get your money back after a foreclosure. If you're a second or a junior lien position, you're behind it and you may not have enough equity for you to get fully repaid. So it's riskier, but it also might pay a little bit more. All right, you want to look at the loan to value, how much equity might be realized in the property. I like to look at things that are 75% loan to value or less. So it looks like if you had an after repair market value called ARV, so what it's valued at after all the repairs. If it was $100,000, the max loan I would like to see on it would be $75,000, 75%. You also want to make sure that you understand the market and the property comparisons. Like, is this, once the house gets renovated or built, will it really actually sell for that after repair value? Is the market supportive of that? Are the properties supportive of that? You want to look at borrower's experiences. Does he have any skin in the game? He or she have any skin in the game? Meaning, does he have any of his own or her own money invested in it? And does he have any money to back up any default of the loan or maybe other property. I want to vet the lending broker. So a lot of times there's a broker in between the people who have the money and the people who want to borrow it. And it's a broker, and they'll deal with all the closing, they'll deal with the loan paperwork, they'll deal with the payments, getting the payments for the borrower. They get an upfront fee or points for doing that service. You want to know if the construction company is experienced and trustworthy. And then the borrower exit strategy. That just means, how is a loan going to be repaid? And it's usually one of two ways: sale of the property or refinance, and then they get a traditional, less pricey loan that will carry them for long term. Show me the money. Private lending, usually paid monthly or quarterly on interest only, and the interest is always 30 days after the loan start, not before. The principal of the loan is usually a balloon payment, so it's like all of the money that they borrowed is paid in full at the end of the term. Terms usually range from about 6 months to 18 months. Not unusual to have them renewed if they're 6 months, like for another 6 months, with a little bit of extra money given to the broker. Things always happen during the course of a loan, so if your loan gets extended, it's really no big deal. You're just making money for an extra month or so. Just for easy math, if you have a $100,000 loan at 12% yields $12,000 annually. Divide that by 12, and you get $1,000 every month in the mailbox, cash flow. Disclaimer, know your tax rate. I'm not a CPA. Do know this is taxed as ordinary income. Be aware. That's a little bit of the due diligence. It's like, what's going to happen when you make some money? Just a few case studies. Case study number 1. This is a single family fix and flip. A loan was $100,000 at an interest rate of 10%. It was 12 months, and it lasted 12 months. And it paid $833.33 a month for $10,000 total over that year. Case study number 2, another single family fix and flip. Loan was $40,000 out of an IRA, interest 12%. There are 2 points paid up front, 2% of that loan paid up front, $800 paid up front. This one was a 6-month term, but they got a refinance in 2 months. So we got 2 payments of $400, paid total over 2 months was $1,600. Number 3 is a new build. So instead of a fix and flip, from the ground up, new construction. $60,000 loan, interest rate 12%. The term was 6 months. Then they got into some building delays, some permit delays. The buyer wanted some changes to it. We got a 6-month extension, and then it got delayed because of other things. It happens. 2-month more extension, 14 months total. There was also some late fees because it wasn't being paid interest on time. We got it all back at closing. Paid about $9,000 in total. And then case study number 4, this JV partnership as a passive equity partner. And what that is, kind of like an upgrade from a loan. But if you want to go into a JV, which is a joint venture with anybody, my true advice is know the people, know the property. Hopefully you've been over to their houses, had coffee with them, know that they have dogs. You want to know these people because you're getting into an agreement with them. You may not have the recourse of foreclosure, but it does pay a little bit more. This was a new build. Loan is $125,000, interest rate at 20% because it really didn't have the protection of foreclosure. So know your stuff. 12 months, and then we got a lump sum on sale of the property of $25,000. All right, so you may be saying, Rebecca, I don't have $100,000. Still got you covered. There's such a thing as crowd-funded private lending. There's a website for that, groundfloor.com. So I'm going to travel on over to groundfloor.com. It's Ground Floor US. You can get started as a minimum of $10. $10 because they crowdsource. And what the heck does that mean? Well, let's slide on over to loans that they're funding. And their loans that they're funding are rated. So D is the lowest. It's like the highest risk. So it has the highest interest rate. B, I think it goes A, B, C, D. Less risk, lower interest rate. I like how they have this the remaining term. This one has 4 months left on it. These guys, are pretty new. This still has about 11 months left on it. The loan to value, payment schedule. Now, I believe all of these are deferred, even interest. This is where it's interesting. This is the number of investors investing in this loan amount. So this is a $425,000 loan, but there's 1,800 investors in it. And then remaining on the loans, $81,000. So most of it's funded. 24 days until that loan closes. And you can invest $10, basically zero risk. So I'm going to put in a link down below. If you click on that link, become an investor with Ground Floor US. Click on the link down below, Ground Floor US. That link will give you a $20 credit if you just even transfer $10 into your account. Here's 20 bucks as of this recording. Click on it, become an investor for 10 bucks. I'll see you with the mailbox and the money. Click subscribe, like, share. Have a good one.